Okay, dear student, let's quickly discuss the edition in your syllabus, FR. And this edition is IFRS 18. First of all, before we discuss IFRS 18, what exactly it is, the first question is why ISB has actually developed this IFRS 18. We already have so many ISs, so many IFRSs, then one more why. Number one, what IFRS 18 has done, IFRS 18 has actually replaced IAS 1. IFRS 18 has actually replaced IAS 1, number one. Now the question is why IFRS 18 has replaced IAS 1. Now try to understand. What are the shortcomings in IAS 1? What are the problems in IAS 1 that today we are talking about IFRS 18, which has actually replaced IAS 1? Actually, when we prepare financial statements, so obviously, we are not preparing financial statements just for our internal usage of the company. There are a number of stakeholders, and every stakeholder is interested in there are a number of stakeholders which have the relationship with our organization, number one. And different stakeholders, they are interested in different performance of the company. Example, if I'm the lender, so I really want to see already what is your gearing. If I'm the investor, if I'm a potential shareholder, I cannot ignore your existing earning per share. I cannot ignore your PE ratio before making investment in your organization's shares. If I'm a potential shareholder, I cannot ignore what you are actually generating from your operations. I cannot ignore that. If I'm the potential shareholder, I cannot ignore what is the revenue and what is the trend of your revenue in your organization. I cannot ignore that. For example, if my company is the potential buyer of XYZ company, so obviously I have to go through the financial statements in a very different way because my company wants to buy another company. Now the problem is IAS 1 was not giving us the opportunity to compare different organizations' financial statements. Even though number of organizations are competitors, but because of IAS 1, financial statements were not comparable. Why they were not comparable? Because of IAS 1, there's a question. The question, because in IAS 1, we do not have the detailed categories of different items. For example, while preparing the income statement, profit and loss statement, IAS 1 does not tell us what is coming from the operations. IAS 1 does not tell us in the income statement what is happening in the investing activities, of the company. What is happening in the financing activities of the company? Now the question comes normally in everyone's mind that, sir, if income statement is not giving me answer of these different questions, then what is the problem? We do have a cash flow statement. Cash flow statement can easily let us know what entities are doing in their operations, investing activities, and financing activities. Now, let me tell you one thing. The operating activities, operating category, investing category, and financing category, which I'm talking about, which P&L is not giving me the information, that is not exactly the same which is in cash flow statement. So this is not exactly the same which is in cash flow statement, number one. That is why if someone thinks after listening to that income statement is not giving us the information of operations, investing activities, and financing, we do have a cash flow statement. So basically, both are different. How they are different, you will see that. So now what has happened basically? Okay, now another issue is in IAS 1, due to not having clarity, what people were doing, same information, some of the organization they were showing as an aggregate information, and some of the organization they were showing the same information separately. For example, assuming there is an impairment loss in the goodwill. So if XYZ entity takes that impairment loss to the admin expense, IAS 1 will not stop that entity. If another entity decides to show impairment loss separately, that is also acceptable under IAS 1. Now, there's a problem in comparability. How? It means admin expense of one organization with another will not be comparable because one entity has shown the goodwill impairment loss in their admin expense, another has shown the impairment loss separately. So that's one of the problems. There are a number of things like that. So now actually what has happened that due to this development of IFRS 18, number one, it has replaced IAS 1. Number two, the significant change which is going to come in the financial statement. We know that financial statement is having five components. That is your income statement. We have got SOFP, we have got statement of changes in equity, cash flow statement, and notes to the accounts. The component of financial statement which will have a significant impact, I would say the major change you will see now from here onwards, that is in the profit and loss statement. Now from here onwards, after implementation of IFRS 18, income statement will have 5 categories: operating categories, investing categories, financing categories, income taxes categories, and discontinued operations categories. Now, each organization will prepare their income statement under these 5 categories. What comes under each category, we are going to discuss. So, significant change. For example, if a multiple choice question comes in FR that on which financial statement IFRS 18 is having a significant impact, the answer is profit and loss statement. And which IFRS 18 has replaced IAS 1. Now, why it has replaced, the main problem is IAS 1 was creating problem in comparability. We were not able to compare financial statement of different entities. And especially the objection, you can say, came from the investor's point of view. Nowadays, we are more concerned, we have more concern for the investors. We really want to know that what investors they want to see in our financial statements. That is why, just because of the investor perspective, we have introduced sustainability standard S1 and S2. You will study that later on in SBR, don't worry. But the point is, major change of IFRS 18, a very significant change is in the income statement. Another point, IFRS 18 is compulsory for every entity to apply from 1st January 2027. But early adoption is allowed. But in ACCA, from here onwards, in every attempt, IFRS 18 is applicable. One more thing you need to know for a multiple choice question, IFRS 18 is applicable retrospectively. Retrospectively means, for example, practically, assuming 2027 is the first year for all the organization or some of the organization, because some of the organization, they may apply IFRS 18 earlier than 2027. But assuming practically there is a company which applies IFRS 18 first time in their financial statement in 2027, then according to IFRS 18, you have to apply IFRS 18 retrospectively, which means that comparative financial statement of 2026, you have to restate 2026 financial statements according to IFRS 18. So basically, if a multiple choice question comes and that question is asking IFRS 18, do we need to apply prospectively or retrospectively? The answer is retrospectively. If 2027, this is the main point where you have to follow IFRS 18, then 2026 books you need to restate according to IFRS 18. Now let's come here. IFRS 18 has introduced categories into the statement of profit and loss. What are these categories? 5 categories. Operating category, investing category, financing category, income taxes category, and discontinued operation categories. Now, what comes in operating? Income tax and discontinued operation. The operating category is used for income and expenses which are not classified in one of the other 4 categories. Any income and expense which is not classified in the last or 4 categories, that will be presented under operating categories. You will get to know. Just wait. The proper format, everything is available. The income taxes category is used for tax income and tax expense which arise applying IAS 12. You know that under IAS 12, there is current tax as well as we have got deferred tax. So for income tax categories, we follow IAS 12. The discontinued operations category is used for income and expenses arising from discontinued operation as defined by IFRS 5. Non-current asset held for sale and discontinued operation. So discontinued operation category, for discontinued operation category, we follow IFRS 5. Now, please don't forget one thing. What comes in operating category? Every income and expense which is not covered by the 4 categories: investing, financing, income tax, and discontinued operation, that will come in operating category. Now, what comes in investing category? Now, this is important. The investing category is used for income and expenses arising from investment in associate. If your company has made an investment in associate, we know that associate is an organization where parents holding is between 20 to 50% normally. Otherwise, we know the main concept is not 20 to 50%. The main concept is where you have got a significant influence. That company is your associate. And how do we know significant influence? Normally, you have a directorship chair, and directorship chair is the indication that you have got significant influence in that company. So if there is an associate, what do? We calculate income from associate. Now that you will show in under investing category. Cash and cash equivalent. If you recall, OD, overdraft, OD is actually treated as cash and cash equivalent. So interest expense on OD, you need to show under investing category. That is cash and cash equivalent. Other asset, if they generate a return individually and largely independent of others' resources, this would typically include debt or equity investment, simply trade investment and investment properties. For example, IAS 40, fair value model. We know that IAS 40 fair value model, the changes in the fair value you have to show in income statement in the P&L, but now under investing categories. If your company has made an investment in ordinary shares of XYZ company and you have received the dividend on that investment, that dividend income you have to show under investing category. If you have made the investment in the debentures of XYZ company, so the interest income which you are receiving from the company, you have to show that under investing categories. Okay. This means that income and expenses such as interest and dividends in relation to the investment, rental income, depreciation, gains and losses on disposal in relation to investment properties, not in relation to property, plant and equipment. Fair value gains and losses and other share of profit loss of associate will all be included in investing categories. Now try to understand. All the income and expenses, interest and dividends in relation to investment, rental income, depreciation and gains, losses on disposal of, you have sold the investment property, whatever the gain or loss comes on investment property, that you have to show in investing category. If you are selling the property, plant and equipment, whatever the gain or loss comes, you will not show that in investing category, because your property, plant and equipment, you are using that in your operations. It is not your investment. The depreciation on property, plant and equipment, you will show that in your operations. You will not show that in your investing activities. Now there's a question. The question is, why IFRS is saying depreciation, gains, okay, gains or losses on disposal in relation to investment property, that makes sense. The question is, why depreciation on investment property is coming under investing categories? Number one, listen to me carefully. Normally, we keep our investment properties at fair value, normally. And fair value category or fair value model is actually recommendable by IAS 40, and it is very logical also, because investment property, it is your investment. Obviously, investors, existing investors as well as potential investors, they will not be interested to know how much you paid for the investment. Everyone is interested to know what is the fair value of your investment today. And we know that under IAS 40 investment property, we never depreciate investment property under fair value model. But if entity says we cannot determine the fair value, or entity chooses cost model for investment property, they should not be doing this, but assuming if an entity chooses cost model for investment properties, then depreciation on that investment property you have to show under investing categories. Okay. Now let's talk about financing categories. Because IAS 40 cost model, we do depreciate investment properties. There's a possibility that you might have a question in exam, in a multiple choice question. There are two depreciation. One is investment property depreciation, another is property, plant and equipment depreciation, and an examiner is asking which depreciation should be shown where. The answer is investment property depreciation under investing category, property, plant and equipment under operating category. Now, financing category. Some liabilities arise from transaction which only involve raising finance. These include bank loans and issue of loan notes. Obviously, if you're taking bank loan, you have to pay interest. Income and expenses from initial and subsequent measurement of these liabilities, including derecognition, are reported in financing categories. These income and expense include items such as interest expense. And also look at this. Dividends declared on issued shares which are classified as liabilities. For example, redeemable preference shares or preference shares with a fixed dividend. Now listen carefully. Your company is raising loan from the, your company is taking loan from the bank. It's a financing category. Obviously, the interest which you are paying on bank loan, you have to show in that under financing category. Your company is issuing debenture to raise the finance. So interest which your company will pay on the XYZ debenture, you have to show that in financing category, under financing category. Even the dividend declared. Now, which dividend? We are not talking about dividend declared for ordinary shareholders. No. Dividend declared to ordinary shareholders, we do not show in the income statement at all. What IFRS 18 is saying, please read it nicely. Dividend declared on issued shares which are classified as what? Liabilities. Actually, we are talking about redeemable preference shares. We are talking about preference shares with a fixed dividend. So we know that according to IAS, you can say 32, according to IFRS 9, redeemable preference shares are your financial liabilities, even though the word is shares, but they are not equity instrument. They are actually financial liabilities. So obviously, On redeemable preference shares, if company says we have given the dividend, we have declared the dividend, even though you are using the term dividend, logically, technically, that dividend is not dividend, that dividend is your finance cost. So those shares, they have classified as financial liabilities, they are classified as liabilities. So dividend declared on those shares, you have to show under financing category as finance cost. Some liabilities arise from transactions which do not only involve raising of finance. For example, now there's a possibility you're not raising the finance, still there is a liability, number one, and second is still there is a financing cost. So above paragraph says some liabilities will arise when you are raising the finance. There's a possibility that liability will arise even though you're not raising the finance. Some liabilities arise from transactions which do not only involve raising of finance. For example, lease liabilities. I'm not raising the finance, even though you can say lease is also a source of finance, but actually I'm not getting any cash. I'm getting a property, plant and equipment right of use asset, but I'm not getting any cash. For example, lease liability and decommissioning provision. The decommissioning provision is an excellent example of a liability where I'm not raising any finance at all. What happens if there is a property, plant and equipment, and assuming it has a useful life of 10 years, and assuming after the useful life I have to dismantle that property, plant and equipment? So what do? First, we calculate present value of that decommissioning cost. The double entry is property, plant and equipment debit, provision credit. But after that, slowly and gradually, what do? Due to unwinding of discount, I do charge finance cost to my income statement and increase the provision. Now that finance cost you have to show under financing categories. Now try to understand. It means under financing categories, there are two types of liabilities. On those liabilities, when you are paying interest, that interest you have to show under financing categories. One, the financial liability, you can say the liability will arise when you are raising the finance, like issue of debentures, taking bank loan. Another is those shares which are declared as liabilities, like redeemable preference shares. Of course, by issuing redeemable preference shares, we do raise finance. But liability could arise even you are not raising the finance, like lease liability and decommissioning provision. So the interest element, which we know that when I'm making annual installment of the lease, that has two component. One is interest component, another is principal component. So interest I have to show under financing category. Provisions, unwinding of discount, the double entries, finance cost, debit, provision, credit. So I have to show that also under financing categories. Now, what is the impact of these new categories on answering you are expecting from candidate? Let's see. As a result of issue of IFRS 18, the statement of profit and loss will most likely be more detailed, include additional line items. However, it is not considered a significant impact to prepare or to be presented with IFRS 18 financial statement in FR exam. You should be especially aware of guidance given in the scenario as to where income or expense is to be presented. This is not a new concept and exists in historical exams. Actually, all the expenses, incomes, they were there previously also. Now what are we doing? We're just categorizing it. Previously we were not categorizing them, now we are categorizing them. This is the only difference. What other important changes have been made to the statement of profit and loss are relevant to FR? One of the most important changes in FR, in changes in IFRS 18, is the introduction of mandatory subtotal in the statement of P&L, and these are operating profit or loss. Number one, you have to show this. Profit loss before financing and income taxes. Second, the third one is profit or loss. That is what was previously referred as profit for the year. Please check this nicely. There's a possibility of having a multiple choice question just on this. Okay, any question? Let's see. One of the most important changes in IFRS 18 is the introduction of mandatory subtotals. In the statement of profit and loss, these are operating profit or loss, profit or loss before finance and income tax. Now, it looks that both are same. They are not same. They are not same at all. Operating profit is different. Profit or loss before financing income tax is different. You will just see. Just wait a few minutes. And the last one is profit or loss. That is, previously we used to say profit for the year. Note that both operating profit, the first one, and profit or loss before financing income taxes will be presented. Look at this, what they're saying. Even they're the same amount. IFRS 18 is not giving you the permission. If even they're the same amount, you cannot say, since both are the same amount, so I don't want to show the two separate line item. No, you have to show it. You have to. You do not have any other choice. Gross profit and profit before income taxes are not mandatory subtotals. Student, look at this. Another multiple choice question, I would say. 1, 2, 3. The first three mandatory subtotals. Mandatory subtotals are operating profit, profit or loss before financing and income taxes, and profit or loss. And there are two which are not mandatory. One is gross profit. If you do not want to show, it's up to you. Gross profit and profit before income tax. It's not saying, look, there's a difference between profit before financing and income tax you have to show, but profit before income tax are not mandatory subtotals. However, many entities will present these as additional subtotal because they are necessary for the statement of profit and loss to provide a useful structured summary of income, and it's up to them. But if a multiple choice question comes in FR, that what subtotals are mandatory and what are not mandatory, you need to know this. In FR exam, you will see these presented and expected to be presented when preparing what financial statements. Now, this performer will give you a really good knowledge, I would say. You can see that we are showing the comparative as well. Statement of profit and loss. For let's say they are preparing group financial statement, consolidated statement of financial performance for the year ended this, then a statement of profit and loss. After that, look at the heading. First category. Income and expenses from operating activities. Income and expenses from operating activities. Revenue, cost of sale. Then we've got gross profit. And we know that subtotal of gross profit is not a mandatory category. After that, other operating income, operating expenses, selling expenses, research and development expenses, general admin expenses. And then look at this. Goodwill impairment loss. Students, goodwill impairment loss, you have to show separately. You cannot add goodwill impairment loss in any other expense. And if there is any other operating expense, show that. Now, after that, operating profit. Mandatory subtotal. Operating profit is mandatory subtotal. Gross profit is not mandatory subtotal, not mandatory. Operating profit is mandatory. After that, look at the heading. Income and expenses from investing activities. Can I say category 2? Income and expenses from investing activities. Share of profit or loss from associate and joint ventures. Other investment income. Now, what do you mean by other investment income? There's a possibility you might have invested in the debentures of XYZ company. So the interest income relating to that debenture, that is other investment income. There's a possibility that you have a trade investment and dividend is coming on that trade investment, you will show in other investment income as other investment income. Okay, now look at this. After that, profit before financing and income tax is mandatory category. Mandatory. Now try to understand. Profit before financing and income tax. What comes after that? Income and expenses from financing activities. That is category 3. Now, I want to say one thing. If, for example, there's a possibility organization does not have any associate, can I say if a company does not have associate, does not have a joint venture, so share of profit or loss from associate will not come, number 1. If entity has not made investment in any debentures of XYZ company, if organization has not made any investment in ordinary shares, so there's, let's say there's no rental income, there is no investment property, so there will be no other investment income. Can I say if there is no other investment income, if there is no investment in associate, so logically in investing activities there will be nothing. If in investing activities there will be nothing, then operating profit and profit before financing and income tax will be same. But according to IFRS 18, even operating profit and profit before financing and income taxes, they are same. Still, you have to show both separately as line items. But when they will be same, let me repeat, if an entity does not have any investing activities, like entity does not have any associate, entity has not made any investment, either in debentures or ordinary shares, then obviously there's nothing in the investing activities. If nothing is in investing under investing activities, then obviously there will be no difference between operating profit and profit before financing and income taxes. But let me repeat, even there is no difference between operating profit and profit before financing and income taxes, still you have to show both of them. So mandatory totals. Operating profit, mandatory total. Profit before financing and income taxes, mandatory total. Profit before income taxes, can I say this is not a mandatory total? Let's go back and check. Not mandatory. Let's see. So gross profit and profit before income tax. Profit before income tax. Profit before income tax. So profit before income tax, not mandatory. Gross profit, not mandatory. But still, entities, they do show additional subtotals. It's okay, it's fine. Income taxes category, that is 4. Profit for the year from continuing operations. After that, we have got loss or profit from discontinued operation, that is category number 5. Then final profit. The last profit is mandatory subtotal. Now, after that, we have got a statement presenting other comprehensive income. Now, obviously in FR, we don't have that much detail, but let me just give you the idea. Statement presenting other comprehensive income, we are talking about OCI. Now listen. According to IFRS 18, and it was there in IAS 1 as well, items which are classified under OCI, they should be reclassified in 2 categories. One, those items, they will be recycled to P&L, and those items, they will not be recycled to P&L. For example, IAS 16, revaluation surplus. Revaluation surplus under IAS 16, revaluation surplus under IAS 38 can never be recycled to P&L. For example, I have sold the property, plant and equipment, and in the carrying amount of that property, plant and equipment, there's a revaluation surplus of 5 million also. So that 5 million revaluation surplus, you can close that to the retained earning. You cannot bring that to the income statement. You cannot bring that to the P&L. So you cannot that revaluation surplus cannot be recycled to P&L at disposal. But there are examples where changes which we are showing, let's say in 2025 in OCI, there's a possibility the same thing I might show in the income statement in the profit and loss in 2026. Assuming, example, the example is we have got parent, subsidiary, and the subsidiary is overseas subsidiary. Now listen carefully. Actually, whatever foreign exchange differences they arise during the year, we regarding that overseas subsidy, we show those foreign exchange differences in OCI. But if you sell the overseas subsidiary, at the disposal of overseas subsidiary, the previously recognized gains or losses in OCI will be recycled to P&L. So just an idea that under OCI, there will be items, they will be recycled to P&L, and there will be items, they will not be recycled to P&L, but every item is not covered in FR. But still, I'm just giving you the idea. Statement presenting other comprehensive income. Look at the heading, please. Income and expenses that will not be reclassified to P&L. Gains on property revaluation, IAS 16. Gains on remeasurement of defined benefit pension plans, that's not in our syllabus, IAS 19. Share of other income of associate, there's a possibility you have an associate and associate IAS 28. Associate, we know that joint venture is IFRS 11. We know that if your associate is having gain or loss in OCI, so I have to take the share in the OCI as well. The last one is income tax relating to income and expenses that will not be reclassified. Now listen carefully, student. Those items, they will not be reclassified to P&L. First, you have to show them. After that, their tax you have to show separately. If an entity wants to show gains on property revaluation directly net of tax, gains on remeasurement of defined benefit pension plans net of tax, not allowed by IFRS 18. You can see that you have to show the tax separately. For example, we know that due to revaluation surplus, deferred tax liability will arise. So that deferred tax liability you have to show separately. That deferred tax you have to show separately in under OCI heading. So simply you cannot net off the items. You have to show that income tax separately. Then you will get total income and expenses that will not be reclassified to P&L. After that, income and expenses that will be reclassified to profit and loss when specific conditions are met. Like exchange differences on translating foreign operations. I've just given you the example. At disposal of overseas subsidy, whatever previously different exchange differences you have shown in OCI, they will be recycled to P&L. Available for sale financial asset. For example, debt instrument. You have made an investment in debt instrument which is classified as fair value through OCI category. If you sell the debt instrument which is classified to fair value through OCI category, it is written in IFRS 9 at the time of disposal, the debt instrument which is measured under fair value through OCI category, previously recognized gains or losses in OCI will be recycled to income statement. Losses on cash flow hedges, they come under IFRS 9 but not in our FR syllabus. Then there will be an income tax relating to income and expenses that will be reclassified to P&L when specific conditions are met. Then total income and expense, other comprehensive income. Then there will be a final other comprehensive income, total net of tax. Then there will be a total comprehensive income. So you can see that there are so many line items they have now added to give more and more information to the user of financial statements. Okay, now profit attributable to owners of parent, NCI, total comprehensive income. Okay, basic and diluted EPS. Now let's go ahead. Now this is again very important. Are the principles in IFRS 18 around aggregation, disaggregation examinable in FR? The answer is yes. As I've just discussed that you cannot show impairment loss and goodwill in admin expense. You have to show it separately. But admin expense of, let's say, your human resource department, your legal department, even your accountancy department, you can club together. Look at this. IFRS 18 is clear that entities should aggregate items in financial statements based on shared characteristics. Similarly, entities should disaggregate items based on characteristics which are not shared. This process is vital so that the primary financial statement provide useful structure, summaries to their primary users. For example, an entity might have various activities such as human resource, information technology, legal accounting. They have shared characteristics and so might be aggregated into a single line item in the statement of profit and loss, labeled as what? General administrative expenses. But a goodwill impairment loss, for example, does not share characteristics with the human resource, information technology, legal accountancy cost included within the general administrative expense. If the goodwill impairment loss is material by magnitude or nature, then aggregation it with these other expenses would not be appropriate because material information would be obscured, then it will be unclear. It is most likely that in FR that there will be an instruction to present goodwill impairment loss as a separate line item. As previously noted, in FR exam scenario has historically provided guidance on where some specific items of income or expenses should be presented. If an operating expense is to be disaggregated, this will be stated in the scenario and credit will be awarded for this. For example, you may be told to present material research expenditure as disaggregated expense. That is a separate line item. Within operating expenses, credit would be awarded for following this instruction. Failure to do so therefore would mean not achieving what? Full credit which is available. How might management define performance measure be? No, it's not examinable. Basically, in IFRS 18, they have introduced, you can say, new type of ratio analysis. And the name is management defined performance measure. But management define performance measures, they are in SBR, they are not in FR. What impact has the issue of IFRS 18 on the statement of cash flow? Now listen, on the statement of cash flow, it has a minimal impact, but it has an impact. Let me explain quickly. Interest paid previously, we used to show under operating expenses, under operating activities, as well as financing, both were allowed. But now after the introduction of IFRS 18, interest paid must only be shown under financing activities. Dividend paid must only be shown in financing activities. The issue of IFRS 18 has led to the consequential amendment of IAS 7 statement of cash flow. Previously, when presenting the cash generated from operations using indirect method, an entity would start the reconciliation with the profit before income tax figure. Now listen, now profit and loss, or now cash flow statement will start from operating profit. Previously, we used to start cash flow statement from profit before tax. Now you have to start from operating profit. And operating profit is different from the profit which is before financing and income taxes. Statement of profit and loss. Now IFRS 18 requires to disclose a figure of operating profit. This has changed. You will start your cash flow statement from operating profit. And come here, please, quickly. This operating profit is not the operating profit which we used to study previously. Previously, we were saying operating profit is profit before interest and tax. Now look at this. I'm talking about this first one, because operating profit is different and profit before financing and income tax is different. You will start your cash flow statement from operating profit, the first mandatory total category, you can say. Look at the cash flow statement. Cash flows from operating activities, operating profit, the first mandatory total, adjustment for depreciation, amortization, impairment, foreign exchange gains. You can see that we are not adding interest expense, which we previously used to add, because previously we were preparing cash flow statement, we were starting it from profit before tax. Now you will start from operating profit. So there will be no adjustment of interest expense. Then you will get operating profit before depreciation, amortization, impairment loss, and foreign exchange gains. After adjusting these 4 items, you will get operating profit before depreciation, amortization, impairment loss, and foreign exchange gains. Then simply working capital, decrease in inventory, receivable, trade, and other payable. Then you will get cash from operating activities before income tax. Then income tax paid, then there will be a final answer. Net cash from operating activities. As can be seen, the reconciliation now starts from operating profit. Moreover, IAS 7 does not refer to cash generated from operations. This has been replaced from cash from operating activities before income tax. Before IFRS, before the issue of IFRS 18, IAS 7 permitted entities to choose whether present interest paid and dividend paid as cash flows from operating activities or as cash from financing activities. Now, student, it has to be financing. As a result of amendment made to IAS 7, dividends paid must be presented as a financing activities, and most entities, unless you are told to otherwise in the scenario, must also show interest paid as a financing activity. In FR exam, you may be required to present extract from the statement of cash flow or may be asked to interpret the financial information presenting in a statement of cash flow. This should not change significantly. Obviously, it will remain same. We do have past papers like that, where you are required to prepare extracts of cash flow statement and interpretation. As the issue of IFRS 18 had the other consequences amendment which are relevant to FR exam, yes. Now, going concern assumption, previously it is dealt under IAS 1. Now this going concern assumption has moved from IAS 1 to IAS 8, and there's a change in the name of IAS 8 also. Now IAS 8 new name is basis of preparing financial statement. Look at this. The principle relating to the going concern assumption were previously found in IAS 1. So student, again, a multiple choice question could be on this area. The principle relating to the going concern assumption were previously found in IAS 1 presentation of financial statement. This content has been moved over IAS 8, basis of preparing financial statements. The name of IAS 8 has also changed. Previously, this was called IAS 8 accounting policies, changes in accounting estimate and errors. This has insignificant impact, of course, on FR exam, because only one change from IAS 1, it has moved to IAS 8. Now, what impact will IFRS 18 have on the section A and B in FR exam? The impact on section A and B containing solely objective text question is insignificant. Information on the most part will be presented in IFRS 18 format, and IFRS 18 terminology will be used. Care should be taken, for example, in any question on the statement of cash flow or more generally on the format of financial statement. Both are impacted by IFRS 18 disclosed above. Interpretation of financial statement also examinable in section A and B. However, we will discuss IFRS 18 impact on section C below, which is very, very important. Because ratio analysis, now there is a change. There's an impact on ratio analysis as well. Let's see. What impact will IFRS 18 have on section C in FR exam? In section C, you must answer 2 questions, one in each area. Preparing of financial statement, individual company or group company. Interpretation of financial statement, could be a group companies or individual. Remember that in each exam, you will have one question on an individual company and one in on non-complex group. Now, preparation of financial statement. You will be required to prepare a statement of financial position, a statement of P&L, which may include other comprehensive income, or a statement of changes in equity. You may also be required to prepare extract. Okay. Whereas there are minimal changes to the statement of financial position, of very little changes there. Statement of changes in equity, IFRS 18 format should still be followed. For extract from the statement of cash flow, you must remember that indirect method now starts from operating profit, not profit before income and index. Also, you must remember dividend paid, interest paid, you have to present in their financing activities. The statement of profit and loss has the most change, 5 categories. You should be aware of the pro forma and all its subtotals shown above and be able to prepare financial statement in this format. Remember to follow any guidance on the presentation, disaggregated items within the operating expense, which will be included in the scenario. Now, this is important part, very important. Interpretation of financial statement. When interpreting financial statement, it is important to recognize the information presented in IFRS 18 format. Be careful when selecting line items to use calculation of ratios. When calculating return on capital employed and interest cover, the numerator is profit before financing and income taxes. Numerator. Come here. The first mandatory total is operating profit. You will not take that. Let me change the color of the pen. Previously, we were taking operating profit. Now listen. This operating profit, red one is okay, I believe. This operating profit you will not take. Instead of this operating profit, you will work on profit before financing and income taxes, because if there is any investing activity, if there is any income which is coming from investing activities, then operating profit and profit before financing income taxes, they will be different. If a student is then using operating profit, then your ratio will be incorrect. So for return on capital employed, for interest covered, which profit comes in the numerator? The second mandatory total, profit before financing and income taxes. And of course, if there is no investing activity in an organization, then operating profit and profit before financing and income taxes will be same. But please make sure for calculating return on capital employed, for calculating interest cover, you will be using profit before financing and income taxes. It means return on capital employed, I'll be using profit before financing and income taxes. Divided by capital employed. And we know that total equity plus your long-term debt, you will get capital employed, or total asset minus current liabilities will give you capital employed. Interest cover, I'll take profit before financing and income tax divided by interest. You will get interest cover, and we know that this is first one is in percentage and the second one comes in times. And this is the second mandatory total of the profit, which we will be using in ROC, which we'll be using in interest cover. Just 2-minute break. Azan is sounding. Just 2 minutes, please. So let's come back here. Okay, let's see. Where were we? Interpretation of financial statement. So simply, you are not supposed to confuse. Be careful not to confuse with profit before income tax, because profit before income tax is different than profit before financing and income tax. So don't get confused just by initialism that both are having profit before, but one is profit before financing and income tax, and second is profit before income tax. Both are different, and you will be using profit before financing and income taxes. Okay, when calculating assets turnover, you may only use operating profit margin in your calculation if operating profit is equal to profit before financing and income taxes. Now, hold on. It is possible that your operating profit is actually equal to profit before financing and income taxes. It is possible, but when it is possible, that is, there is no investment income. If there is no investment income, if you go back to the format again, where it is. Just here. Look at this. If there is no investment income, like there is no share of profit or loss from associate, there is no other investment income. If there is no investment income, then obviously operating profit and profit before financing and income taxes will be same. Then if you are using operating profit margin, it's okay, perfectly fine. But listen, if there is an investment income, then operating profit and profit before financing and income tax will not be same. Let's come here. Oh, just okay. Just give me 2 minutes, please. Just 2 minutes. Okay. Now, return on capital employed divided by operating profit margin will give the incorrect answer if a question includes what? Investment income. Of course, if the question includes investment income, then operating profit is different and profit before financing income taxes will be different. Similarly, when calculating return on capital employed and interest cover, the use of operating profit is not appropriate when there is investment income. Both operating profit and profit before financing and income tax will be presented even they are the same in accordance with IFRS 18. So students, this is all about your, I would say, article on IFRS 18 given by, of course, ACCA. So we have discussed each and every line of IFRS 18, and I'm expecting at least around to 8 to 10 marks in your exam. So I would say just go through this article at least 2 to 3 times. Number one. Number two, that's my expectation, and I'm confident enough also that in a pre-seen mock, I'm expecting a question on this IFRS 18. And that will give you a really good idea that exactly which type of question we should be expecting on this IFRS 18. But IFRS 18 is affecting your ratio analysis as well. If you're taking a wrong figure from the income statement, you will be making the mistake. Like operating profit is something different than profit before financing and income taxes. They're not the same. They both could be same if there's no investment income. So of course there will be heavy involvement of IFRS 18, I would say, in the ratio analysis, but let me just give you the quick overview. The main reason why IFRS 18 is actually replaced IAS 1. IAS 1 was creating actually inconsistency. There was a problem in the comparability of financial statement of different entities. Now IFRS 18 is, I would say, so comprehensive that at least I can't see that happening, that in the near future there will be any big major change or any other IFRS coming to replace IFRS 18. There's a possibility in the future we might see a little bit change in IFRS 18, but I can't see, at least in the near future, that any other IFRS is going to replace IFRS 18. So I would say, student, go through this video once again, at least, and then read the article 2 to 3 times. And that is all about your IFRS 18 new area in FR. So I would say thank you very much. Before I end the class, is there anything you want to ask? I'm just pausing. Let me pause the video. Is there anything you want to ask? So you can